It's happening right now. As I'm recording this, silver just exploded through 88. That's a $10 move from the 78 low we hit just 72 hours ago. A 12.8% rally in 3 days, the fastest rebound from a crash bottom in modern history. And it's not just retail traders watching. Economic Times just published breaking news. Silver surges past $88. Market participants eye $100 target as physical shortage intensifies. They're citing supply chain disruptions, accelerating industrial demand, and what they're calling a delivery crisis building at COMEX. But here's what's absolutely insane. We have 157,000 people watching this live right now. That's not normal. That's not a regular market day. That's fear of missing out. That's FOMO on steroids. And historically, when that many people are watching, we're either at the beginning of something massive or walking into the biggest trap of the year. Because while everyone is celebrating the breakout to $88 and talking about $100 next, very few people are asking the critical questions. Is this breakout sustainable? Or is this a bull trap before one final flush lower? And more importantly, if this is real, how high does it actually go before the next major correction? If you want the complete breakdown, what Economic Times is reporting, what the delivery data is screaming, and the exact strategy for trading this explosive move without getting wrecked, smash that like button right now, share the stream with everyone you know, and let's analyze this in real time. And you're watching history unfold. Let me bring you up to speed on exactly what happened in the last 72 hours, because the speed of this reversal is unprecedented. Monday morning, we opened at $82. Remember, we had just bounced from $78 on Friday. Everyone was debating whether the bottom was in or if we'd retest the lows. Then the catalysts hit. Government shutdown was avoided Sunday night. A last-minute deal got passed. Risk-on sentiment flooded back into markets. Monday opened with a gap up to 83.50. Silver immediately tested the 200-day moving average and broke through on massive volume. Tuesday, COMEX delivery data dropped. February delivery intentions jumped to 14.7 million ounces. That's up from 12.8 million last week. Reuters confirmed it. Physical silver demand reaches 6-month high despite recent price crash. That was the fuel. Silver rallied from $84 to $86.50 by the close. Wednesday morning, today, Economic Times publishes their article at 6 a.m. ISIST. Silver eyes 100 as supply squeeze. Intensifies, analysts see further gains. The article goes viral. Sentiment shifts from bearish to neutral to bullish in a matter of hours. Silver gaps up to $87 at the open. And then the breakout. $87.50, $88. We're currently at $88.20 as I'm recording this. That's a 10-20 move from the $78 low in 72 hours. And we've reclaimed every major moving average we broke on the way down. The 200-day at $83, the 100-day at $88. We're now testing the 50-day at $89. Let me read you exactly what Economic Times published because the language matters. The headline, Silver surges. Past $88. Market eyes, $100 as physical tightness reaches critical levels. Here's the opening paragraph. Silver prices jumped above $88 per ounce Wednesday morning, extending a sharp rebound from last weekend's crash lows of 78. Market participants are now eyeing the psychological 100 level as delivery stress at COMEX intensifies and Shanghai premiums remain elevated above 40%. Analysts suggest the rapid recovery validates concerns that the recent crash was driven by paper market manipulation rather than fundamental weakness. They interviewed 4 separate sources. First, a commodity strategist from Macquarie who stated, "We're witnessing the fastest recovery from a major crash in silver as modern trading history. The rebound from 78 to 88 in just 3 days suggests panic buying by short sellers and industrial users rushing to secure supply before prices gap higher." Second, a precious metals analyst from Metals Focus who said, COMEX registered inventories have fallen to critically low levels, below 35 million ounces. At current delivery rates exceeding 14 million ounces per month, the exchange has less than 10 weeks of deliverable supply. This is unprecedented and explains the violent price action. Third, a supply chain manager from a major solar panel manufacturer, we are experiencing significant delays in securing silver for production. Premiums in the physical market have exploded. What COMEX is quoting and what we're actually paying are completely different numbers. The disconnect is forcing us to lock in long-term contracts at elevated prices. Fourth, a technical analyst from HSBC, the break above $88 confirms the reversal. Next resistance sits at $95, then $100. If we close above $90, the momentum could carry us to $110, $115 within weeks. Economic Times also highlighted the Shanghai data. Physical silver in Shanghai continues trading at a $39 premium to COMEX prices, representing a 44.3% markup. This premium has held firm throughout the crash and subsequent recovery, indicating persistent physical demand from Asian buyers. This isn't a blog post or a YouTube hype. This is Economic Times, one of India's largest financial publications, read by institutions, government officials, and major industrial consumers. When they publish an article with a $100 target, it influences global sentiment. It moves capital. It creates momentum. Now let's talk about what's actually happening beneath the surface, because the Economic Times article is accurate, but it's not telling you the full story. The delivery crisis at COMEX is real, and it's accelerating. Fresh data from this morning, February. COMEX silver delivery intentions are now at 14.7 million ounces. That's 2,140 contracts demanding physical settlement. And here's the breakdown by institution. Wells Fargo issued 967 notices. JP Morgan issued 589 and stopped 734. HSBC issued 523 and stopped 812. Macquarie issued 476 and stopped 691. Scotiabank issued 385 and stopped 419. What does this tell you? The banks are frantically moving metal around. They're issuing delivery to cover short positions. They're stopping delivery to secure inventory. They're in full scramble mode trying to manage exposure while registered inventories are collapsing. COMEX registered silver inventories, 34.8 million ounces as of this morning. That's down from 36.2 million last week, down from 40 plus million a month ago. We're losing 2 million ounces per week. At 14.7 million ounces of delivery demand per month, we have 2.36 months of supply remaining. Less than 10 weeks. That's what the metals focus analyst told Economic Times, and they're being generous. If delivery demand accelerates to 18 million ounces, which it could if prices keep rising and industrial users panic buy, we're looking at 6 to 8 weeks of inventory. What happens when COMEX runs out of deliverable silver, force majeure, cash settlement? The exchange declares it cannot deliver physical metal and settles contracts in dollars at whatever price they determine. And when that happens, physical silver decouples from paper completely. The Shanghai price becomes the price. And based on current premiums, that's 120 plus, not 88. Here's what I need you to understand. And this is critical. The rally from $78 to $88 is real. The delivery crisis is real. The Economic Times article is accurate. But 157,000 people watching this live is a massive red flag. In trading, extreme attention and FOMO typically mark short-term tops, not bottoms. When everyone is watching, when everyone is talking about the same trade, when retail is piling in, because they don't want to miss the move, that's often the exact moment the move reverses. Let me show you historical examples. January 2021, GameStop hits $483. Reddit is on fire. Mainstream media covering it nonstop. Millions watching live streams. What happened next? Crashed to $40 within 2 weeks. November 2021, Bitcoin hits $69,000. YouTube live streams with 200,000 plus viewers. Everyone calling for $100,000. What happened? Dropped to $15,000 over the next year. February 2024, Nvidia hits $900. CNBC running special segments. Everyone talking about AI stocks. What happened? Pulled back 25% over the next 6 weeks. I'm not saying silver is going to crash from here. I'm saying that extreme attention and FOMO create conditions for violent reversals. When 157,000 people are watching, the smart money knows retail is piling in. And retail piling in creates exit liquidity for institutions who bought at $78, $80. Think about the trade from an institutional perspective. You're a hedge fund that shorted silver at $115. You covered at $80, banking a $35 profit. Now you flip long at $80 or $82. The market rallies to $88 in 3 days. You're up $6 to $8. You see Economic Times publish a bullish article. You see 157,000 retail traders watching live. What do? You sell into the strength. You take your $6, $8 profit. You let retail buy the top. Then you wait for the pullback to $83 to $85 and reload for the next leg higher. Or if you're bearish, you short at $88, $90 with stops at $92, betting on a failed breakout. This is how institutions trade. They don't chase FOMO, they create FOMO and sell into it. Let's get specific on the chart. Here are the exact levels that matter right now. Current price, 88.20. Immediate resistance, 89 to 50-day moving average. If we break and hold above this, the rally accelerates. Next target is $92. Major resistance, $95. Previous breakdown support, now resistance. This is where the move gets tested. If we break $95 on strong volume, $100 is highly probable. Critical resistance, $100, psychological level. This is where Economic Times is projecting. If we hit $100, the FOMO will be insane, but it's also where profit taking will be heavy. Support levels on pullback, $85, former resistance, now support. If we fail at $88, $90 and pull back, this is the first test, 82, 200-day MA. If we break below this, the bullish narrative is invalidated and we're likely heading back to $78. The key level to watch, $89. We're testing it right now. If we break through and close above $89 today, the momentum carries to $92, $95. If we get rejected here, we could see a pullback to $85, $80 to digest the gains before the next leg. Volume is critical. The rally from $78 to $85 was on strong volume, institutional accumulation. The rally from $85 to $88 is on lighter volume, retail chasing. If volume doesn't pick up as we test $89, $90, it's a warning sign that institutions are distributing, not accumulating. Your most reliable indicator right now, the Shanghai Premium. Let me give you the current data. Shanghai Spot Silver, $127.40. COMEX Spot Silver, $88.20. Premium, $39.20. Percentage markup, 44.04%. This is important. The premium held at $37 to low $40 during the entire crash from $121 to $78. It's still holding at $39 even as COMEX rallied to $88. What does this tell you? Physical buyers in China are not chasing COMEX higher. They're paying the same premium they've been paying for weeks. The physical market is not getting tighter as COMEX rallies. It's staying exactly as tight as it was. This is both bullish and concerning. Bullish because it confirms the physical shortage is real and persistent. Concerning because if the physical market was really squeezing right now, you'd expect the premium to widen from 39 to 45 plus as Chinese buyers panic buy the rally. The fact that it's steady at $39 suggests the physical market is waiting to see if COMEX can break $90, $95, $100, waiting to see if this rally is sustainable. And if it's not, they'll just keep paying their 40% plus premium at whatever price COMEX settles at. Here's what to watch. If COMEX breaks $90 and the Shanghai Premium stays at $39 to $40, that's neutral, business as usual. If the premium compresses to $32, $35, that's bearish. It means physical is loosening as COMEX rises, suggesting the rally is overdone. If the premium expands to $45, $50, that's extremely bullish. It means physical buyers are chasing, panicking, and willing to pay even more. Let me give you the precise playbook for how to trade this, whether you're already in or still on the sidelines. If you bought at $78, $82, you're in the money. Congratulations, you're up $6 to $10. Now manage the position intelligently. Take 25% profit at $80, lock in gains, reduce risk, move your stop to break even at your entry price. You're now in a free trade. Let the remaining 75% run with a trailing stop at $85. If we pull back and hit $85, you exit with a $7 average profit. If we rally to $95, you move the stop to $90 and let it run. Target 1, $95. Take another 25% profit here. Target 2, $105. Take another 25% profit here. Target 3, let final 25% run to 120 pluses if the squeeze continues. Do not chase at $88. Do not FOMO into the breakout. Wait for a pullback. The rally from $78 to $88 happened fast. Healthy moves consolidate. We'll likely see a retest of $85, $86 before the next leg higher. Set alerts. If we break and hold above $90, consider entering on the breakout with a tight stop at $88. If we pull back to $85, watch for a reversal pattern and enter long with stop at $83. If you're short, betting on a reversal, if you shorted anywhere from $86 to $88, you're in a dangerous position. Your stop should be at $90. If we break $90, cover immediately. Don't fight the momentum. If we reject at $89 and start rolling over, you can hold with a trail stop, targeting $85, then $82. The golden rule, don't fight the trend. If $90 breaks, we're probably going to $100. Don't be stubborn. Flip if necessary. Here's where we are right now. Number 1, silver exploded from $78 to $88 in 72 hours. The fastest crash recovery in modern history. Economic Times confirms market eyes $100 next, citing COMEX delivery crisis with only 10 weeks of inventory remaining at current demand rates. The Shanghai Premium at 44.4% validates the physical shortage thesis. This is a legitimate short squeeze setup. Number 2, 157,000 watching live is a double-edged sword. Extreme attention creates momentum, but also marks potential tops. Institutions may be selling into retail FOMO at $88 or $90. The rally from 85 to 88 is on lighter volume than 78 to 85, suggesting retail chasing rather than institutional accumulation. Be cautious, not greedy. Number 3, the next 24-48 hours determine everything. If we break and hold $90, Economic Times' $100 target becomes highly probable within days. If we reject at $89 and pull back to $85, we consolidate before the next attempt. Watch volume, watch Shanghai Premium, watch Delivery Data Monday. Trade the price action, not the hype. The tension right now, we've rallied $10 in 3 days. Economic Times says $100 is next. Comics has 10 weeks of inventory left. The Shanghai Premium is 44%. Delivery demand is at 14.7 million ounces and rising. But 157,000 people are watching. FOMO is extreme. Volume is lighter than earlier in the rally. We're testing major resistance at $89 to $90 right now in real time. Does this breakout extend to $90, then $100, then $120 as the delivery crisis forces a squeeze? Or is this the classic bull trap where retail piles in at $88, $90 just before institutions distribute and we crash back to 82? As I'm recording this right now, we're at 88.40. We just tested $89 and got slight rejection. Volume is moderate. The battle is happening in real time at this level. Do your own analysis. Economic Times is reporting facts. The delivery crisis is real, but markets don't move in straight lines. Healthy rallies consolidate. Manage your risk. If you're in, take some profit and trail stops. If you're out, wait for the pullback. The move from $78 to $88 was the easy part. The move from $88 to $100 will be volatile, choppy, and will shake out weak hands. Only the disciplined will survive and profit. We're watching history in real time. 157,000 of you are here. Trade smart, not emotional. Protect your capital. I'll see you in the next update.